This is Money Talks. I'm Greg Bogle, Portfolio Manager at GKV Capital Management. We wanted to share a few thoughts on the Russian invasion of Ukraine relative to the stock market. The economic impact of any political crisis is often difficult to estimate, particularly in the early days as the crisis is still unfolding. Historically speaking, geopolitical crises don't generally have lasting economic consequences. The impact on stocks is usually short-lived. Initially, an unexpected crisis creates uncertainty, which causes investors to lower their risk tolerance. When in doubt, the automatic reaction is to protect assets and liquidate at least some positions. The onset of the COVID pandemic in February 2020 is a good example. The S&P 500 collapsed 34% in 4 weeks as it became apparent that whole economies would have to shut down to control the spread of the virus. As new infection rates began to slow and governments worldwide flooded consumers, businesses, and markets with stimulus, it became clear that the pandemic could be controlled and economies would reopen. U.S. equity prices bounced back quickly and hit new highs within 6 months. Corporate earnings reaccelerated sharply, with strong consumer and corporate spending driving stocks to new highs. We're deeply saddened by the war in Ukraine. We naively thought, like much of the developed world, that large-scale wars in Europe had been relegated to the history books. This pervasive view is what makes Putin's attack so surprising. And because it's so unexpected, there will be lasting repercussions. It's the lasting effects that we want to focus on from an investment standpoint. The initial reaction in the equity markets has been fairly measured. The uncertainty leading up to the invasion caused more selling on Wall Street than the war itself, at least so far. In fact, the U.S. major indices rallied sharply after the first round of sanctions were announced on February 23rd. The unfortunate expectation was that this event was likely to be over quickly, that Russia would subsume its neighbor. It would be sanctioned once again, but the economic world would move on. Most importantly, it was expected that Russia's critical energy industry would be excluded from sanctions, keeping energy costs from dramatically rising in Europe, which would only exacerbate a growing inflation problem. Much to our delight, the people of Ukraine are fighting for their young democracy. Their heroism has spurred greater support around the world, uniting often fractious European Union and NATO. Effective sanctions require a consensus. Unprecedented sanctions on Russia's central bank reduced the value of the ruble by 25% overnight, and interest rates have been doubled to 20% to support the currency. The new restrictions will significantly impact Russia's economy and its military over time. Unfortunately, the Ukrainians don't have a lot of time. When the crisis in Ukraine, while it's still far from over, there are a few assumptions that we can make that are relevant to the investment landscape. There are very few companies in the S&P 500 with considerable exposure to Russia or Ukraine. Ironically, the U.S. company with the greatest sales exposure is Philip Morris. We're trying to kill the Russians with our cigarettes. Philip Morris sales to Russia totals about 8% of their revenue. McDonald's and Pepsi each have about 4% of their sales attributable to the area, and Deere has a little less than that. The direct sales impact for U.S. companies is very small. So Putin's demonstrated the necessity of NATO and an effective security infrastructure. This includes a need for both advanced weaponry and cybersecurity. It is notable that less than 5 days into the invasion, Germany has announced that it will increase defense spending above 2% of gross domestic product from 1.4% last year. For many years, the U.S. and other allies have argued in vain for Germany to increase its defense spending. We anticipate that defense spending will increase globally in the coming years. Here's a chart of military expenditures as a percentage of GDP since 1960. From a high of nearly 7%, military spending has steadily declined over the last 60 years, hitting a low 2.36% last year. The numbers here get very large. Raising spending back to 3% of global GDP, for example, would be an increase of more than $500 billion spent annually. Defense and aerospace stocks, such as Lockheed Martin and Northrop Grumman, have significantly exceeded the S&P 500 over the last 10 years, and with rising defense budgets, we anticipate continued growth. Certainly, cybersecurity is another obvious market segment that will see increased spending. Cyber attacks are low cost and deniable, making them an effective tool to retaliate against sanctions. The problem here for investors is that many of the security technology companies already have high valuations. Companies we follow include Palo Alto Networks, Tenable, Fortinet, CrowdStrike, Mandiant, Checkpoint. Inflation has become the primary issue for the developed economies in the world. This year, the U.S. Federal Reserve and the European Central Bank will raise interest rates to rein in rising prices. But rising rates will slow economic growth. As long as the economy is strong enough, higher rates should not slow growth too much or risk pushing the economy into a recession. Unfortunately, the conflict in Ukraine and sanctions on Russia will likely exacerbate inflationary pressures, particularly for critical energy, food, and many commodities. Europe, particularly Germany, imports much of their oil and gas from Russia. Additionally, Ukraine is a major exporter of both wheat and corn to Europe. So the war further adds disruption, inflation, and uncertainty for macroeconomic growth. All of these factors, particularly rising inflation and rising interest rates to combat it, may force slower growth than anticipated prior to the conflict. Here's a table of forecast annual GDP growth for the US, the EU, Russia, and worldwide. The International Monetary Fund had forecast the EU to grow GDP 4% in 2022 after a strong rebound of 5.2% last year. With increased energy and food costs and likely higher interest rates, the 4% forecast this year may be too optimistic. The GDP growth estimates prior to the invasion will clearly have to be revised sharply lower for Russia due to sanctions. After the less substantive 2014 sanctions, Russia's GDP declined 3.7%. Note that the Russian recession in 2014 was worse than the recession during the pandemic. Sanctions do have an impact. The war over Ukraine will be very costly for Russia. With lower growth rates in Europe, it may be that revenue and earnings forecasts will need to be trimmed slightly this year and even next. We anticipate good growth for the U.S. in 2022, but with high valuations, rising interest rates, and now increased geopolitical risks, we expect stocks to drift sideways much of this year, at least until we have more clarity on both inflation and economic growth. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports directly in your inbox. Thank you for watching.